Chapter 13. The Stock Market. In this lecture, we are going to discuss two major topics. The first one is computing the price of common stock through four methods, which are: first, the one-period valuation model; second, the generalized dividend valuation model; third, the Gordon growth model; fourth, price earnings valuation method. The second topic is how the market sets security prices. Let us begin with computing the price of common stock. One basic principle of finance is that the value of any investment is found by computing the value today of all cash flows the investment will generate over its life. For example, a commercial building will sell for a price that reflects the net cash flows it's projected to have over its useful life. Similarly, we value common stock at the value in today's dollars or pounds, whatever the currency, of all future cash flows. The cash flows a stockholder may earn from stock are dividends, or the sales price, or both. To develop the theory of stock valuation, we should consider the following methods. First, the one-period valuation model. Second, the generalized dividend valuation model. Third, the Gordon growth model. Fourth, price earnings valuation method. The one-period valuation model. This model assumes that you buy the stock and hold it for one period to get a dividend, then sell the stock. Now, suppose that you have some extra money to invest for 1 year. After a year, you will need to sell your investment to pay tuition. After watching Wall Street Week on TV, you decide that you want to buy Intel Corporation stock. You call your broker and find that Intel is currently pays 0.16 per year in dividends. The analyst on Wall Street Week predicts selling for $50 per share, that the stock will be selling for $60 in 1 year. Now, should you buy this stock? To answer this question, you need to determine whether the current price accurately reflects the analyst's forecast, so you can use the equation you see, the equation number 1, where P0, the current price of the stock. The 0 subscript refers to time period 0, or the present, while D1, the dividend paid at the end of year 1. KE, the required return on investments in equity. P1, the price at the end of the first year. This is the assumed sales price of the stock. Now, find the value of the Intel stock given the figures reported above. you will need to know the required return on equity to find the present value of the cash flows. Since a stock is more risky than a bond, you will require a higher return than that offered in the bond market. Assume that, after careful consideration, you decide that you would be satisfied to earn 12% on the investment. Solution: putting the numbers into equation 1 yields the following stock price, which is $53.71. Based on your analysis, you find that the stock is worth $53.71. Since the stock is currently available for $50 per share, you would choose to buy it. Now, why is the stock selling for less than $53.71? It may be because other investors place a different risk on the cash flows estimate the cash flows to be less than you do. The Neutralized Dividend Valuation Model. The one-period dividend valuation model can be extended to any number of periods. The concept remains the same. The value of stock is the present value of all future cash flows. The only cash flows that an investor will receive are dividends and a final sales price when the stock is ultimately sold. The generalized formula for a stock can be written as in equation 2, the equation you see. Note that if Pn is far in the future, it will not affect P0. So, the generalized dividend model is rewritten in equation 3 without the final sales price. The Gordon growth model. The generalized dividend valuation model requires that we compute the present value of an infinite stream of dividends, a process that could be difficult to say the least. Therefore, simplified models have been developed to make the calculations easier. One such model is the Gordon growth model, which assumes constant dividend growth. Note that many firms strive to increase their dividends at a constant rate each year. Now, equation 4 you see rewrites the equation 3 to reflect the constant growth in dividends, where D0 the most recent dividend paid, G the expected constant growth rate in dividends, K the required return on an investment in equity. Note that equation 4 has been simplified using some algebra to obtain equation 5 you see. This model is useful for finding the value of a stock given a few assumptions. First, dividends are assumed to be continue growing at a constant rate forever. Second, the growth rate is assumed to be less than the required return on equity. For example, find the current market price of Coca-Cola stock, assuming dividends grow at a constant rate of 10.95% and D0 equals $1 and the required return is 13%. By using equation 5, Coca-Cola stock should sell for $54.12 if the assumptions regarding the constant growth rate and required return are correct. Price earnings valuation method. Theoretically, the best method of stock valuation is the dividend valuation approach. But sometimes, however, it is difficult to apply. If a firm is not paying dividends or has a very erratic growth rate, the results may not be satisfactory. Other approaches to stock valuation are sometimes applied. Among the more popular is the price earnings multiple. The price earnings ratio is a widely watched measure of how much the market is willing to pay for $1 of earnings from a firm. The price earnings ratio can be used to estimate the value of a firm's stock. Note that, algebraically, the product of the price earnings ratio times expected earnings is the firm's stock price. The equation 6 explains how to compute the stock price through the product of price earnings ratio times expected earnings. Note that firms in the same industry are expected to have similar price earnings ratios in the long run. The value of a firm's stock can be found by multiplying the average industry price earnings times the expected earnings per share. Now, a high price earnings has two interpretations. First, a higher than average price earnings may mean that the market expects earnings to rise in the future. This would return the price earnings to a more normal level. Second, a high price earnings may alternatively indicate that the market feels the firm's earnings are very low risk and is therefore willing to pay a premium for them. For example, the average industry price earnings ratio for restaurants similar to Applebee's is 23. What is the current price of Applebee's if earnings per share are projected to be $1.13? By using equation 6 and the data given, we find that the price of the stock is $26. The price earnings ratio approach is especially useful for valuing privately held firms and firms that don't pay dividends. The weakness of the price earnings approach to valuation is that by using an industry average price earnings ratio, firm-specific factors that might contribute to a long-term price earnings ratio above or below the average are ignored in the analysis. A skilled analyst will adjust the price earnings ratio up or down to reflect unique characteristics of a firm when estimating its stock price. How the market sets security prices. Suppose that you are considering the purchase of a stock expected to pay dividends of $2 next year, which means D1 equals $2. The firm is expected to grow at 3% infinitively, which means G equals 3%. You are quite uncertain about both the constancy of the dividend stream and the accuracy of the estimated growth rate. To compensate yourself for this risk, you require a return of 15%. Now, suppose Jennifer, another investor, had spoken with industry insiders and feels more confident about the projected cash flows. Jennifer requires only a 12% return because her perceived risk is lower than yours. But on the other hand, is dating the CEO of the company. He knows with near certainty what the future of the firm actually is. He thinks that both the estimated growth rate and the estimated cash flows are lower than what they will actually be in the future. Because he sees almost no risk in this investment, he requires only a 7% return. Now, what are the values each investor will give to the stock? By applying the Gordon growth model, yields the following stock prices, which are presented in the table in the next slide. Now you are willing to pay $16.67 for the stock. Jennifer would pay up to $22.22 and Bud would pay $50. The investor with the lowest perceived risk is willing to pay the most for the stock. If there were no other traders, the market price would be just above $22.22. Now, if you already held the stock, you would sell it to Bud. The point of this section is that the players in the market bidding against each other establish the market price. When new information is released about a firm, expectations change, and with them, prices change. New information can cause changes in expectations about the level of future dividends or the risk of those dividends. Since market participants are constantly receiving new information and constantly revising their expectations, it is reasonable that stock prices are constantly changing as